All right. So now we're going to talk about the subsequent measurement and disclosure in relation to intangible asset under Ind AS 38. The subsequent measurement guidance or requirement under Ind AS 38 is also fairly similar to what we talked about for fixed assets or for tangible assets. What does that mean? It means that there are three types of thing is what you need to remember, right? One is that the basis of cost, the basis of recognition subsequent to the initial recognition. So you can do historical cost model or you can do a revaluation model. The only difference here on a revaluation model that there has to be an active market which has to exist for you to do revaluation model for intangible asset. So it is extremely rare. Virtually it's just not possible. Honestly, I haven't experienced any company doing fair value model for intangible asset. We do still see some companies doing fair value for tangible assets, and that also, as I said, is for land or buildings. For intangible asset, though the standard permits that you can do fair value, but we don't see in practice that any company doing fair value because there is no active market which exist for these type of intangible assets. Active markets exist for financial assets or other assets which are then not accounted for under Ind AS 38, but they are accounted for under Ind AS 32. So essentially then companies end up doing your historical cost model. So you have historical cost model and you have a revaluation model. Now historical cost model, whatever your cost, then you do an amortize, you determine the useful life, you determine the residual amount and the net amount, the total cost which you've incurred minus the residual amount, that amount becomes, then you need to determine the estimated useful life. Over the estimated useful life is what you need to amortize that intangible asset. There could be a situation, right, that you may have an intangible asset with an indeterminable useful life, right? To say it's not infinite, so to say, it is indefinite, that you're not able to determine this, right? If you're not able to determine this, then you are not required to amortize this on an ongoing basis. You are then required to test it for impairment. And we see this ordinarily for assets like brand, right? For brand, it is often at times difficult to determine the period over which this asset needs to be amortized, especially when you have acquired a brand, because it's a self-generated brand, it is anyway not allowed to be capitalized. But if you acquired a brand in an external transaction, then you may have the ability to say that I am not able to determine the useful life and hence I'm going to test it for impairment, as opposed to in a way amortizing it on a year-on-year basis. But if you can determine, then you need to amortize it over that useful life. Or for example, goodwill, and we're going to talk a lot more about goodwill when we will discuss Ind AS 103. Goodwill is an asset, intangible asset, which is considered as an asset which has an indeterminable useful life, so to say, and hence goodwill is always tested for impairment, as is not required to be amortized. Goodwill as an intangible asset is always tested for impairment, but for all other intangible assets which are covered under Ind AS 38, you need to amortize it based on its estimated useful life, and then minus the residual value. That net amount is what is required to be amortized over its useful life, right? And you can follow the cost model or you follow the revaluation model. Revaluation model is only allowed to be followed if there is an active market which exists for that type of intangible asset. And if you are following revaluation model, then again the same principle. If there's an increase in fair value, that increase in fair value will go to other comprehensive income. If there is a decrease in fair value, then that goes to profit and loss account. However, if there was a previous increase in fair value which was recorded in OCI, then such decrease you can recoup it from the OCI, etc., etc. So all of this is what you need to look at, understand, remember, as you're trying to understand the subsequent measurement accounting for intangible assets. So Accounting is the cost model or the revaluation model. Now, what is the cost model? Is my cost which I have capitalized less the accumulated amortization, if any, or the impairment, if any. And we talked about that impairment, and we're going to cover a lot more in detail as to how do you determine the impairment, right? How do you determine the impairment? If you're following a revaluation model, then the revalued amount being fair value with reference to an active market. Now, remember, this is what was not there when we were doing revaluation model for tangible asset, but for intangible asset, there's another hurdle which you need to cross if you were to apply intangible asset fair value, or which is reference to an active market. The revaluation option is only available if there is an active market, one in which transactions are of sufficient frequency and volume to provide a price on an ongoing basis for the intangible assets. So active market is again further defined in Ind AS 113, right, on fair value guidance. So again, you got to look at that. So remember, you just not allowed to apply revaluation model unless there is an active market which exists. So if you're doing a revaluation, assuming you have an active market, you will do the revalued amount, you will do the accumulated amortization and the accumulated impairment. This has to be impairment, right? Accumulated impairment. All right. So then that's the model. So quickly then talking about the revaluation model, if there's a subsequent increase in the revaluation, increase in the carrying value of the intangible asset as a result of revaluation. So I remember what I said, the increase in fair value that will go to other comprehensive income. If there is a increase, shall be recognized in profit and loss to the extent that it reverses a previous revaluation decrease of the same asset previously recognized in profit or loss. If there is just offsetting, if there is a if I had previously recorded a loss in the P&L, then the increase will get offset in the P&Ls, right? Otherwise, if there's a decrease as a result of revaluation, then decrease goes to profit or loss, unless decrease will be recognized in OCI to the extent of previous increase which was recorded in OCI. If it is simply offsetting that previous increase, then you can record it through OCI. However, as I said, remember, it is extremely rare. In fact, in my experience, I have not seen any company financial statement where intangible assets are actually accounted for using the revaluation model. But theoretically, it is possible to account for intangible assets using the revaluation model. So let's look at this example. Okay, here Sigma Limited follows revaluation model. As I said, right, the revaluation model we see very rarely for intangible assets in real practice. Okay, but let's look at this example. It says that why? Because and first of all, for fixed asset also it's very rare. Okay, but it is okay. It is in some situation we do see, right? But for intangible, it's extremely rare, because there's an additional requirement for doing fair value is the observable market condition, and that observable market or these intangible assets are generally not traded. Okay, and hence no company does fair value accounting for intangible asset. But theoretically, assuming, let's say, if somebody is doing it, so Sigma Limited follows a revaluation model to measure its intangible asset. All right. On 31st of December 2018, it purchased an intangible asset for INR 10 lakhs. The asset has a fair value of INR 12 lakhs on 31st of December 2019 and 8.5 lakhs at 31st of December 2020. It's like yo-yoing, right? At one time it is going up and then it's coming down. Okay, that's what is happening here. Now, there's another company, Omega Limited, follows revaluation model to measure its intangible assets. On 31st December 2018, it has purchased an intangible asset for INR 10 lakhs. The asset has a fair value of INR 8.5 lakh at 31st December 2019 and INR 10.5 lakhs. So again, it has come down and then it has gone up, right, in that situation. So the question here is, how should Sigma Limited and Omega Limited account for the above transaction under Ind AS 38 in its financial statement for the respective year? Ignore amortization. All right. So remember the principle, if you are doing a revaluation, first make sure all conditions for revaluation is permitted. That revaluation you are allowed to do for a class of asset. In case of intangible asset, it also requires that class of asset has to be traded, right? Assuming in this fact pattern it is there. So now the revaluation gain, if there is a revaluation upside, that goes to other comprehensive income. If the revaluation results into a revaluation loss, that charged to profit and loss account. To the extent you have previously taken it to the gain, revaluation gain in other comprehensive income, in the subsequent period if there is a loss, you first offset the gain which is sitting in OCI. Over and above that goes into profit and loss account. And similarly, if you first charge the loss to the P&L and subsequently there is a gain, then you want to reverse that loss first, and then over and above that will go to other comprehensive income, right? From that perspective. So that's the broad principles, right, which we've been talking. So let's look at the solution here. First for Sigma Limited, and then we will look at for Omega. Here revaluation gain of INR 2 lakh on 31st December 2019. So we'll first go to revaluation reserve in recognizing other comprehensive income, right, which is OCI. Okay. Now, then there is a revaluation decrease of INR 3.5 lakh on 31st December 2020, out of which 2 lakh first should be debited to revaluation reserve. And balance 1.5 lakh should be recognized as an expense in the statement of profit or loss account. Okay, awesome, simple, easy. Now let's look at Omega Limited. In case of Omega Limited, there is first a loss. The loss then will go to profit and loss account, which is 1.5 lakh will go to statement of profit and loss. Now then there is a subsequent increase, revaluation increase of 2 lakhs. So first I will offset the loss. 1.5 lakh should be recognized as income, reversal of previous loss, and the remaining 50,000 should be credited to revaluation reserve and recognized in other comprehensive income, OCI. All right, simple. So if there is a revaluation gain, that goes to other comprehensive income. Now, if there is a revaluation loss, that goes to profit and loss account. That's, let's say, first time you're doing it. Okay. Now, doing it for the second time. Now, what happened here? I had a gain. Now I have a loss. So this loss will first be used to offset the gain. Over and above, if you still have a loss, then that goes to profit and loss account. Now, I had a loss which was charged to P&L. Now I have a gain. So that gain first will be credited to P&L. And then over and above, once you absorb what was debited to P&L, then the balance will go to other comprehensive income. It's intuitive, right? It's a principle which is logical, right? That's what we need to follow. We're going to then look at the useful life of intangible assets. So you got to determine the useful life of the intangible asset. Again, you go to the same principle, that how do you determine is the period over which I intend to use this asset, contractual or legal right over which I can use this asset, right? So over what period I can generate probable future economic benefit, over what period then this intangible asset may become obsolete. Let's say if it is a computer software, now this software may become obsolete because there could be more advanced technology, more advanced softwares which are likely to come. If there's a trademark, if there's a brand, if there is a copyright, if there is a customer contract. So remember all different types of intangible asset we talked about, whether it is marketing related, whether it is customer related, whether it is a legal related, artistic related, technology related, all different types of intangible asset. You got to carefully assess that what's the useful life and what's the residual value, product life cycle, information of useful life, technology, technical or other types of obsolescence, market demand, expected extent by competitors. All of that is what you consider for you to determine. It's an area of judgment. There is no kind of a bright line here. You got to determine under the Indian GAAP, existing Indian GAAP, there's a bright line now which is presumed that 10 years unless you rebut it. Under Ind AS, there is no bright line here. Classified as such, when useful life cannot be determined, you can do an indefinite period, right? Which is not infinite, right? Understand the difference between infinite versus indefinite. Indefinite means I'm not able to determine. If you're not able to determine the useful life, then it is required to be tested for impairment, right? It has to be useful life reviewed at each period end. Indefinite life does not mean infinite, not amortized but only tested for impairment at least annually, but if you are doing the amortization based on the determination of useful life, then the impairment testing is only required when there are triggers, right? When there are triggers, and we're going to talk about more about those triggers when we will cover Ind AS 36. When we will cover Ind AS 36, then we will explain to you what is the meaning of the triggers, which actually results into an impairment assessment. However, if it is an indefinite life intangible asset, then you are mandatorily required to test it for impairment on an annual basis. Whether there are triggers or no triggers, it doesn't matter, right? So that is how you need to determine the useful life. So how do I need to deal with this intangible asset? If there's a finite useful life, I need to test for impairment when there is an indication, or amortize over the useful life. If there is an indefinite useful life, then I need to only test it for impairment on an annual basis. I don't need to then amortize it. I am only required to test it for impairment on an annual basis if there's an indefinite life intangible asset. If it is a definite life intangible asset, then I need to amortize it and test it for impairment when there are triggers for impairment assessment, from that perspective. Let's look at this example of an acquired customer list, right? There is an example on an acquired customer list. A direct mail marketing company acquires a customer list and expect that it will be able to derive benefit from the information on the list for at least 1 year, but no more than 3 years, right? So 1 year to 3 years is somewhere is what they believe that they will be able to derive and generate future economic benefit. Suggest how the acquired customer list will be amortized. The customer list, first you need to assess that whether it meets the definition of an intangible asset. When it will meet the definition of an intangible asset, if it is identifiable, mean it is separable, or there is a contractual or legal right. So I've acquired a customer list, right? It is separable, it is identifiable, right? And then I need to say that should I, whether then it meets the recognition criteria. When it meets the recognition criteria, is that do I have the control over it? Do I have the, whether I'll be able to generate the future economic benefit? Now control is I'll be able to use it and drive future economic benefit or restrict others from the usage of that asset. And the probable future economic benefit is I can generate more revenues, I can reduce my cost, or I can sell it and monetize it. So assuming if you purchase it, you're going to use it for a business purpose, you're going to generate new revenue streams, etc., etc. So this customer list in a way is acquired. Remember, self-generated customer lists are not eligible for capitalization, but since it is an acquired customer list, you can capitalize them. Would be amortized over management best estimate of useful life, say 18 months. Between 1 year to 3 years, it can be 1 year, it can be 3 years, it can be 18 months, is the management best estimate of useful life. Although the direct mail marketing company may intend to add more customer names and other information, as internally generated costs are all expensed. They are no further allowed to be capitalized, from that perspective. Let's look at another example of a patent which was acquired to expire in 15 years. The product protected by the patented technology is expected to be a source of net cash inflow for at least 15 years. The entity has a commitment from a third party to purchase that patent after 5 years. So after 5 years, I have a buyer for 60% of the fair value of the patent at the date it was acquired, and the entity intend to sell the patent after 5 years. So even though the life of the patent is say 15 years, I have an intention to use it only for the period of 5 years. After 5 years, I'm going to sell it, right? At what value? 60% of the value, and I already have an identified and committed customer for the same. Now, if that been the case, then the amortization is to be done over a 5-year period. So if 100 is what I paid, 60 is what I have a customer for that. That means 40 is what I need to amortize over a 5-year period. That means every year my expense is going to be 8 rupees in my example. So if 100 is the cost, right, and I'm going to get 60% after 5 years, that means 40 I'm going to divide by 5, and then 8 is what my expenditure every year as an amortization cost. All right, I hope this example is clear that Useful life has to be determined from the perspective of the user of the asset, not the economic life. Economic life may be longer, but the useful life is what you consider for the purpose of depreciation or amortization. And you also need to factor in the residual value. In this case, the residual value is evident, which is the 60% of the value of the asset after 5 years, because you have a committed customer and you also have an intention to do the so, and hence you will be depreciating this asset over 5 years for the value minus the residual amount, which is in my example 40. Right? Let's take another example where you acquired a copyright which has a life of 50 years, for example, right? There's a remaining legal life of 50 years. So let's look at the fact pattern. An analysis of consumer habits and market trend provides further evidence that the copyrighted material will generate net cash inflow only for 30 years. It needs to be noted that remaining life of the patent is 50. Even the life of the patent is 50 years. The benefit of from that asset I can only derive for a 30-year period. What does that mean? That means that I need to then amortize it over a 30-year period and not over a 50-year period. Even though the legal life or the legal protection I have is for 50 years, the economic benefit is I can only generate for 30 years. Hence, I need to amortize this over a 30-year period and not over a 50-year period. I hope this example is also very, very clear to you. Let's look at this example. Here, Kappa Limited acquired a patent on 1st of April 2021 at a consideration of INR 30 lakhs. Okay. The patent has a life of 15 years. The management of Kappa Limited has estimated a useful life of 5 years for the patent, considering the nature of the product. The company follows straight line method for amortization. Okay. As at 1st of April 2022, the management, okay, so what is the useful life here? 5 years, okay. How much I paid? 30 lakhs. As at 1st of April 2022, remember these dates, okay. The management is unsure about the economic feasibility of the process and hence have decided to write down the patent to its estimated fair value of INR 15 lakhs, okay, to be amortized over 2 years. However, as at 1st of April 2023, the company have perfected the process now and have accordingly appraised the patent at a value of INR 30 lakhs with a remaining estimated useful life of 4 years. Assume that the revaluation model is applicable to the patent, okay? And I'm just going to pause here for a second. Okay, so question here is, what's the balance of intangible asset at the end of each year, right? At the end of each year, and what is it we're talking here? We're talking here for at 1st April. So multiple dates we have: 1st April 2021. So we have to do it at 31st of March 2022. Then I am doing at, then there is a triggering event at 1st of April 2022. Then I'm doing at 31st of March 2022. And then I have here 1st April 2023. And then I'm going to do it 31st of March 2023. And I'm doing the revaluation model, assuming the revaluation model is, so these are multiple dates here, right, on which there are multiple things are happening. So I got to be very, very focused here. All right. So let's look at step 1, okay, as to what's happening here. Carrying amount as on March 31st, 2022. So I paid 30 lakhs. My useful life is 5 years. So I'm going to amortize it, right? Over 5 years as provided. So my carrying amount as of March 31st, 2022 is 24 lakhs. Then I get to carrying amount as on March 31st, 2023. Now here there are 2 dates at which I have the information, which is on April 1, 2022. There is an impairment. I got to first assess the impairment and record the impairment loss as and when there's an impairment, right? So now the value has been considered 15 lakhs. So what was my carrying value here was 24 lakhs. So I'm going to record an impairment loss of 9 lakhs. I'm going to record an impairment loss at the beginning of the next financial year, which is 2022-2023. So now I'm left with 15 lakhs, and I've also assessed that my remaining useful life is 2 years. Okay, and as we've been talking, a change in estimated useful life is a change in accounting estimate, okay, to be accounted on a prospective basis. So I've got here the change here. So now this 15 lakh I'm going to depreciate or amortize over 2 years. Okay, so 7.5 lakhs. So what was my revised carrying value after is as of 31st March 2023? So March 31st, sorry, March 31st 2023 is 7.5 lakhs. Now I got to 1st April 2023, and then in a way look at, there's more information available. The value has now been revised upward to 30 lakhs. Okay, so I'm going to first record a revaluation gain here. Okay, so on 1st April 2023 there is a carrying value of 7.5 lakh. The value has been revised upward to 30 lakhs. So there is a revaluation gain of how much? 30 lakhs minus 7, so 22.5 lakhs is the revaluation gain, out of which remember 9 lakh was charged to profit and loss account. So that comes as a credit to the profit and loss account. Okay, and over and above that 9 lakh, which is how much, right? Which is 13.5 lakh, that goes to other comprehensive income. 13.5 lakh goes to other comprehensive income. Now the last bit I'm going to do for 31st March 2024. Okay, basically now I'm going to depreciate how much? Amortize 30 lakhs over 4 years. Okay, 30 lakhs over 4 years, which is 22.5 lakhs is my carrying value as of 31st of March 2024. We move forward to talk to you about the retirement and disposal, and it's very simple that retirement and disposal, either you have sold it or it is no longer in active use. If you have sold it or it is no longer in active use, that means you're not going to derive any future economic benefit. Then you de-recognize this. If there's any gain or loss, that gain or loss again is recorded through profit and loss account. That gain or loss is determined the difference between the net disposal, if any, the carrying amount of the asset. It shall be recognized in profit or loss when the asset is de-recognized. Gain shall not be classified as revenue. They are not revenue. They are to be recorded as gain or loss in your statement of income, not classified as revenue. So when you de-recognize, when you have disposed it or when you have discarded it, that means you're not using it, or you're not going to generate any. Discard means what? You're not going to generate any probable future economic benefit. And then now we come to the almost at the end of this standard, which is to say, what are the disclosure requirements? And remember, disclosure means disclose, disclose, and disclose. So disclose the useful life are indefinite or finite. If finite, the useful life or the amortization rate used, amortization method, which is a straight line method or any other method. It is presumed that you will follow a straight line method for intangible asset. The other method, there are very, very limited situation in which you are allowed to follow another method. The gross carrying amount, the accumulated amortization, if there is any impairment, all of that is what you need to disclose. The line item of the statement in the profit and loss in which the amortization is included, the reconciliation of that, the beginning and the end. All of that, if it is a self-generated intangible, you need to provide more disclosure around the same. If you have acquired intangible in a business combination, you need to disclose that. If you have acquired in an external transaction, you need to disclose that. So tons of disclosure requirement in relation to the intangible asset. What are the measurement methods which are being used, whether you're following a cost model or a revaluation model. If it is an indefinite useful life, you got to disclose that you've done an impairment testing, mandatory impairment testing. So, and again, you go, why you believe that it has an indefinite useful life and you're not able to determine the useful life of the asset, and then that you have done the impairment testing in accordance with the requirement of Ind AS 36. All of that is what you are required to disclose. So quickly to recap what we have talked about, subsequent measurement for intangible assets, two models, cost model and revaluation model. We rarely see the usage of the revaluation model. If you're following revaluation model, additional condition is what you need to meet is that there has to be a presence of an active market. If the active market do not exist for that type of intangible asset, then revaluation model is not permitted. Then you can only follow cost model for the purpose of accounting. In the cost model, you got to then determine the useful life of that asset. And the useful life of the asset, if you're not able to determine, then that is means it's an indefinite life. If it is indefinite life, then you don't amortize it, but you test it for impairment on an annual basis. If you've been able to determine the useful life, then you got to also determine the residual amount. Then whatever is the net amount, that is what is you are required to amortize it over the useful life of the asset. Any change in your estimate of useful life of asset is required to be dealt on a prospective basis. For you to determine the useful life, you again consider the similar factors like the technological obsolescence, the commercial uses, the competitive environment, and your own kind of positioning in the marketplace. All of that is what you consider and use to determine the overall useful life. If you're following revaluation model, then the increase in value goes to other comprehensive income. The decrease in value goes to profit and loss account. To the decrease to the extent of offsetting the previous increase, that will stay in OCI, so on and so forth. So all of that is what we have discussed throughout this session. And I hope all of that is clear to you. Now, quickly to talk through what are the differences between Indian GAAP and Ind AS 38. Indian GAAP is AS 26, which dealt with the requirement of intangible asset, and under Ind AS, it is Ind AS 38. So broadly, the definitions are largely similar, which is say that an asset which is without physical substance. There's no concept of indefinite life under AS 26, and there's a rebuttable presumption that the life of an intangible asset is not more than 10 years, whereas Ind AS in a way acknowledges the fact that there could be an intangible asset which is an indefinite life, and there's no rebuttable presumption of 10 years. Identifiability does not define identifiability AS 26, whereas the Ind AS 38 defines identifiability as something which is separable or something which comes from the contractual or other legal rights. The revenue-based amortization is not possible in a way under the AS 26 model. It is virtually silent, and we don't see that. In AS 38, it is also requires you to do straight line method of amortization, but in typical situations, when the intangible asset is expressed as a measure of revenue, or revenue and consumption of the intangible assets are highly correlated, then you can possibly do the amortization using an attribute other than the straight line method. If the intangible assets which are acquired in a business combination, there's a detailed guidance which exists in Ind AS 103, which we will talk and cover. Under the Indian GAAP, we don't have a detailed framework for business combination other than AS 14, which talks about merger or amalgamation, and hence a very, very restrictive or limited guidance. And you only end up accounting for them if you're accounting amalgamation in the nature of purchase, right? And hence limited guidance exists for intangible assets acquired in a business combination. So there are kind of important distinction which exist between the Indian GAAP and Ind AS. The one most common difference which we deal with is the period of amortization, which is this 10-year rebuttable presumption which is given under Indian GAAP versus no life which is prescribed. And also you could have an intangible asset with an indefinite life, and also the method of amortization, whereas Indian GAAP in a way insist upon to say that you got to do straight line. In the Ind AS also you need to do straight line, but there is a flexibility in limited situation for you to do a method of amortization which is other than straight line method of amortization in that sense. So with this, we come to an end of this session, and now we've talked about intangible asset in great degree of detail. So remember, intangible asset is an asset which without any physical substance, non-monetary asset with no physical substance. And we talked about examples like a book which has a physical, you can feel the book, but the value is actually coming in from the intellectual property or the intellectual knowledge which is inside the book, and hence that's like a copyright, or that's an intangible asset. And then we talked about intangible asset you got to identify, which is like by either is separable or contractual or other legal right. And then we say that you got to deal with the recognition criteria, which is say that do I have control, can I do probable future economic benefit. And then we say when I'm going to capitalize it, can I measure the cost reliably, and then if I can measure the cost reliably, am I going to generate the future economic benefit? If the answer to all of this is yes, then you're going to capitalize this. You can acquire an intangible asset in a variety of ways. You can either do an independent third-party purchase, you can acquire this in a business combination, you can acquire this through a government grant, you can acquire this in a non-monetary exchange, or you can also do a self-generated development of an intangible asset. We talked about accounting for each of the recognition for each of these types of intangible asset, but for self-generated, I think you need to be more careful, because for self-generated, you need to look at the, for internally generated intangible asset, you got to distinguish between the research phase and the development phase. What goes into the research phase, that is expensed as incurred. What goes into the development phase, that is allowed to be capitalized, again provided you meet certain criteria, like you establish the technical feasibility, you have the ability to complete, you're going to generate the probable future economic benefit, all of these criteria you meet, then you are able to capitalize them, and then you need to amortize them. If you're not going to meet these criteria, then you're not allowed to capitalize them. In a pharma industry, we see further higher threshold because of the regulatory approval which is required for some of these drug discovery process. And then we also said there are several types of intangible asset. It could be marketing related, artistic related, technology related, contract related, legal rights, through which, or customer related, through which in a way you acquire all these intangible assets. You got to determine the subsequent accounting for intangible asset is actually related, could be done on a cost model or on a revaluation model. But the revaluation model is very rare, is what we see in practice. Is the cost model is what we see every company follow. From a cost model perspective, then you got to amortize your intangible asset using a straight line method ordinarily, is what we see. Again, for that you need to determine the residual amount. Once you determine the residual amount, on that you got to then amortize it over a useful life. If you're not able to determine the useful life, then you got to test it for impairment on a mandatory basis on an annual every annual period. If you are amortizing the intangible asset on an ongoing basis, then impairment testing is only required when there are certain triggers, and we are going to talk about those triggers in more detail when we will try and cover Ind AS 36 on impairment, from that perspective. And then we also talked about a lot of disclosures which you need to make. So you got to disclose, and disclose the type of intangible asset, the life of the intangible asset, the how you determine the useful life. If you're not able to determine the useful life, why you not able to determine? If you've acquired them, what is the reconciliation between the opening and the closing? All of that, a very, very comprehensive set of disclosures is what you are required to make in relation to intangible asset. And now we're going to cover some more case studies, more examples, which my colleague Amit is going to take you through with this. Thank you very much.